Hi, I'm Dr. Cheryl Dunn, and I'm here to demonstrate a problem for a company called Gold Streets, Inc. And Gold Streets, Inc., they've given us various financial statement numbers for the year, and they have asked us to calculate the debt-to-equity ratio. So take a look at the problem. Okay, the total debt for this company is going to consist of the $92,000 in bonds payable, plus the $19,000 in accounts payable, plus the $23,000 in notes payable, plus $37,000, that's a lease obligation. If we total these together, we get $171,000. Then to get our total equity, the total equity for this company is going to be the $68,000 that's in common stock, plus the $142,000 that's in the additional paid-in capital that APIC stands for additional paid-in capital. So it's what we receive when we sell our common stock on top of the par value. So the par value is recorded in the common stock account. The additional paid-in capital is the additional amount of cash we receive above and beyond the par value. And then we also have retained earnings in this company, which is $96,000. And if we total those together, that's going to give us our total equity as $306,000. Now notice that cash, supplies, and investments are all assets. And so they're not part of the debt-to-equity ratio. The debt-to-equity ratio is simply the total debt divided by the total equity. And so now we're simply going to take that $171,000 and divide it by the $306,000, so the total debt divided by the total equity, and then we're going to round to the nearest two digits. So when we do this division, it comes out to be 0.5588, and then some additional decimal places beyond that. We then round that to be simply 0.56. That's our debt to equity ratio. So in other words, for every dollar of equity that we have 56 cents in debt. To tell if that's a good debt-to-equity ratio, we would need to compare to other companies in the same industry, compare to our own debt-to-equity ratio over time, compare the debt-to-equity ratio to any debt covenants we might have that tells us we need to stay under a certain level for debt-to-equity. But in general, 0.56 is not too bad. Okay, so that's debt-to-equity ratio. Thank you for viewing this demonstration, and I hope you found it helpful.